Okay, so you want to own a storage unit facility. You buy some land, throw up a few metal buildings, slap a gate on the driveway, and watch people pay you every month to store their old couches and Christmas decorations. Passive income. Practically no staff. No perishable inventory. No customers to deal with. Sounds like the most boring, bulletproof business in America. And here's the strange part. It kind of is, but the operators who actually get rich on storage aren't the ones who buy a facility and coast. They're the ones who figured out that this business looks simple on the outside and is a surprisingly precise machine on the inside. Get it right, and you're running a real estate asset that throws off cash like a landlord with 20 tenants and 0 toilets to fix. Get it wrong. Or just get it slightly off, and you're sitting on a half-empty lot full of corrugated metal, bleeding interest payments every month. By the end of this video, you'll know exactly what it costs to get into the business, how the money actually flows, what the real danger zones are, and what a realistic profit looks like, with the math to back it up. We'll also look at who's winning in this industry right now and what one of the most expensive development mistakes in storage history looked like up close. So what does it actually cost to own one of these? The price of entry depends almost entirely on whether you're building from scratch or buying an existing facility. Let's start with building. Land is your first big cost, and land prices swing wildly by location. A 2-acre parcel in a suburban market, close enough to population density to actually fill your units, can run anywhere from $300,000 to well over $1 million depending on the city. In high-demand metros like Los Angeles or Miami, you might pay $2 million just for the dirt before a single wall goes up. In secondary markets, think Tulsa, Boise, or Greenville, you might find suitable land for $200,000 to $400,000. Then you build a basic single-story facility with around 40,000 net rentable square feet. That's the industry term for the actual storage space customers pay for. Will cost roughly $25 to $45 per square foot to construct. So a facility of that size runs $1 million to $1.8 million in construction alone, not counting land. If you go multi-story, which more urban operators are doing to maximize land use, costs jump to $50 to $75 per square foot or higher. Add in paving, perimeter fencing, electronic gates, security cameras, and basic site work, and you're looking at another $200,000 to $500,000 before you open the door. Then there's the management software, the website, signage, insurance, permits, and the kiosk or office setup. All in, a new ground-up facility in a mid-sized market typically runs $3 million to $6 million before you lease a single unit. In expensive coastal markets, that number easily hits $10 million to $15 million. Buying an existing facility is a different calculation. The self-storage industry uses a metric called capitalization rate, or cap rate, to price deals. Cap rate is just a shorthand for how much income a property generates relative to its price. A 6% cap rate on a facility generating $300,000 in net operating income per year implies a purchase price of $5 million. In competitive markets right now, stabilized storage facilities, meaning ones that are already at or near full occupancy, are trading at cap rates of 5 to 6%. That sounds low, but it reflects how much institutional money has flooded into storage since the early 2010s. These aren't fringe investments anymore. They're attracting the same buyers as office buildings and shopping centers. For a smaller, undermanaged facility in a secondary market, you might find cap rates of 7% to 8%, which means more risk, but more room to add value. Realistic entry price for a small existing facility, $1.5 million to $4 million. Mid-sized facility in a suburban market, $5 million to $12 million. Larger facilities in dense metros, $15 million and up. One more thing to know about buying. You're almost always borrowing most of this. SBA loans, CMBS debt, and conventional commercial real estate loans are the typical funding tools. Lenders generally want to see 25 to 30% down on a storage deal. So to buy a $5 million facility, you're typically putting $1.25 million to $1.5 million of your own cash in the door. Now, how do you actually make money with one of these? The core business model is almost brutally simple. You divide space into units. You rent those units out by the month and the rent adds up. That's it. But the details underneath that simplicity are what separate the operators who win from the ones who wonder why their numbers aren't adding up. Storage units come in a range of sizes. The most common are 5x5, 5x10, 10x10, 10x6, 10x6, 10x15, and 10x15. A 5x5, about the size of a large closet, rents for $30 to $80 per month depending on market. A 10x9, which is roughly the size of a small bedroom, goes for $80 to $150 per month in most suburban markets and $150 to $250 in dense urban ones. A 10x21, big enough to fit a full household of furniture, can command $150 to $350 per month. Climate-controlled units, which keep temperature and humidity stable, typically charge a 20 to 40% premium over standard units. Now here's the business model in one line. The whole game is net rentable square feet times rent per square foot times occupancy rate. A 40,000 square foot facility charging an average of $1.10 per square foot per month at 90% occupancy generates about $475,000 in gross revenue per year. That math, 40,000 square feet times $1.10 equals $44,000 per month. Times 12, that's $528,000 annually. At 90% occupancy, you're collecting about $475,000. That's the revenue engine. Now let's talk about what happens to it on the way to your pocket. Operating expenses for a self-storage facility are lower than almost any other real estate type. A typical facility runs on an expense ratio of 30% to 40% of gross revenue. That leaves a net operating income margin of 60% to 70%. Compare that to apartments, which typically run expense ratios of 40 to 50%, or retail, which can be even worse. Storage's lean operating structure is one reason big money loves this asset class. But there are other revenue streams beyond the basic monthly rent that serious operators don't leave on the table. Truck rental partnerships. Many facilities partner with U-Haul or Penske and earn a referral commission, or even operate a small truck rental fleet, which adds $20,000 to $60,000 per year at a mid-sized facility. Retail sales. Boxes, locks, tape, packing supplies sold in the office or through a kiosk. Not a huge line item, but easy incremental revenue with near zero labor, late fees, and administrative fees. Tenants who pay late pay a penalty, usually $15 to $25 per incident. Across hundreds of units, that adds up. This line typically contributes 3% to 6% of gross revenue. Insurance. Most facilities require tenants to carry contents insurance. Many operators act as an agent and offer their own low-cost tenant insurance plan, earning a cut of each premium. This can generate $15,000 to $40,000 per year at scale. Lien sales. When a tenant stops paying, storage law in most states allows the operator to auction the unit's contents after a legally specified notice period. These auctions, made famous by reality TV, rarely recover much, but they do clear the unit so you can re-rent it fast. And there's also wine storage, document storage, RV and boat storage, all niche add-ons that command higher rates per square foot than standard units. A well-run mid-sized facility can pull an additional 10 to 15% of base rent revenue from these ancillary streams if the operator is paying attention. So what's the stuff nobody warns you about? The hidden cost that surprises almost every first-time storage owner is the cost and time of lease-up. You can build a perfect facility in a great market and still not reach 90% occupancy for 2 to 3 years. During that time, you're carrying the full debt load on partial revenue. If your loan payment is $25,000 a month and you're only 50% full, you may be cash flow negative by $8,000 to $12,000 per month. Operators who don't model this carefully run out of cash before they ever get to see the mature income. The rule of thumb: budget 12 to 18 months of operating losses during lease-up for a new build. In a crowded market, push that to 24 months. Next, property taxes. Storage facilities get assessed like commercial real estate, which means property taxes can run 1% to 2% of assessed value per year. On a $5 million facility, that's $50,000 to $100,000 per year out the door before you've covered a single other expense. Then there's deferred maintenance. Metal buildings don't last forever. Roofs need replacing every 20 to 30 years. Doors, roll-up mechanisms, and locks wear out constantly. Smart operators budget 5% to 10% of gross revenue annually for capital expenditures and maintenance reserves. Marketing is a cost almost every first-time owner underestimates. Self-storage is a hyper-local search business. When someone needs storage, they go to Google and type storage units near me. If you're not ranking in the top 3 results and running paid ads, you lose that customer to whoever is. Budgeting $1,500 to $4,000 per month on digital marketing is normal for a mid-sized standalone facility. But here's the thing. If you're up against a branded reparator like Public Storage or Extra Space, their SEO and brand recognition dwarf what a small independent can do with $3,000 a month. This is the competitive threat that keeps small operators up at night. Finally, management cost. If you hire a property management company to run the facility for you, which is common for remote or first-time owners. They charge 5% to 8% of gross revenue. On a $500,000 revenue facility, that's $25,000 to $40,000 per year straight off the top. Self-managing is cheaper, but means someone is on site answering phones, handling lien processes, and chasing late payments. That's a job, not passive income. So who's actually doing this, and at what scale? Let's start with the giants. Public Storage is the largest self-storage company in the United States, with over 3,000 facilities and 210 million square feet of rentable space as of 2024. It's structured as a real estate investment trust, which means it pays out most of its taxable income as dividends and gets special tax treatment. Public Storage generated about $3.8 billion in revenue in 2023 and posted net operating income north of $2.5 billion. That's an NOI margin above 65%. Extra Space Storage, which merged with Life Storage in 2023 in a deal valued at around $15 billion, is now the second largest operator with over 3,500 locations and about $2.9 billion in annual revenue. CubeSmart, National Storage Affiliates, and StorageMart round out the major players. These are not mom-and-pop businesses anymore. The top 5 operators now control over 20% of the entire U.S. storage market. But here's what makes storage fascinating at the individual level. There are still roughly 50,000 self-storage facilities in the United States, and the large majority are independently owned. The REITs dominate revenue and brand recognition, but small operators own the majority of locations. This is one of the last major real estate categories where an individual can still build meaningful wealth without institutional backing. One of the more instructive success stories of the mid-market level is the story of Joe Olivo, a New Jersey operator who built a regional chain of 4 facilities over 15 years before selling to a larger operator in 2018 for approximately $22 million. Olivo started with one facility that he bought distressed for $1.3 million in 2003. It was 55% occupied and mismanaged. He automated the rental process, raised rents aggressively over 3 years as occupancy climbed, added a U-Haul partnership, and got it to 94% occupancy within 2 years. He then refinanced, pulled equity out, and used it to buy his second location. That's the playbook for the successful mid-sized storage operator. Buy underperforming, improve operations, push occupancy, refi, repeat. At the large deal level, consider Blackstone's purchase of Simply Self Storage in 2021 for $1.2 billion, one of the biggest private storage deals in history. Blackstone saw a fragmented market, distressed independent operators, and a chance to aggregate assets, apply institutional-grade management, and sell to a REIT at a premium. That's a different version of the same fundamental model. Buy, improve, and exit at a higher multiple. So how do people lose their shirt on this? The single most common failure pattern in self-storage is building in the wrong market and not figuring that out until it's too late. The temptation is strong. You find cheap land. Construction costs look manageable. There seems to be demand in the area, so you build. What you didn't notice is that 3 other operators had the same idea. They broke ground 12 months before you did. By the time your facility opens, the market is oversupplied. This is exactly what happened in dozens of secondary markets between 2016 and 2020, when low interest rates sparked a self-storage construction boom. Markets like Nashville, Dallas, and Charlotte saw so much new supply come online that average occupancy rates dropped 8 to 12 percentage points. And street rates, the actual price you can charge to a new tenant, fell 10% to 20% in some submarkets. For operators who had borrowed heavily to build, that drop in rent meant the difference between a profitable facility and a cash flow disaster. The hard reality, a self-storage feasibility study is not optional. Before you spend $500,000 on land and permits, you need a third-party analysis of competitive supply, population density, household income, and projected demand. That study costs $3,000 to $8,000. It's the cheapest insurance you'll ever buy. The operators who skip it, or who run the numbers themselves and let optimism do the math, are the ones who end up selling at a loss 3 years in. Okay, so what can you actually walk away with? Let's run 2 scenarios side by side with real math. Scenario 1, the small independent operator. You buy an existing, slightly underperforming facility in a secondary market for $2.2 million. It has 350 units and 28,000 net rentable square feet. Current occupancy is 78%. You put $600,000 down and finance $1.6 million at 6.5% over 20 years. Your monthly debt service is about $11,900. That's $142,800 per year. Year one, you improve the website, start running Google ads, and raise rates on the units that were priced well below market. Over 18 months, you push occupancy to 89%. Revenue at 89% occupancy with an average rent of $1.95 per square foot, $28,000 in fifths. 10% 1I5 times 0.89 equals about $26,100 per month, or $313,000 per year. Add $20,000 per year. Add $20,000 in ancillary revenue from truck rentals, late fees, and tenant insurance. Total gross revenue, $333,000. Operating expenses at 38%, $126,500. Net operating income, $206,500. Subtract debt service of $142,800. Cash flow before taxes, $100. Cash flow before taxes, about $63,700 per year. That's a 10.6% cash-on-cash return on your $600,000 equity. Solid, not spectacular, but here's what makes it interesting over time. If you hold for 7 years, push occupancy further, increase rents with inflation, say 3% per year, and the market cap rate stays at 6%, your facility's value at sale is calculated off a substantially larger NOI. If your NOI grows to $265,000 by year 7 due to rent growth, a buyer at a 6% cap rate pays $4.4 million for it. You sell for $4.4 million, pay off the remaining loan balance of roughly $1.2 million, and walk away with about $3.2 million gross before taxes on an initial $600,000 investment. That's over 5 times your money in 7 years. With a facility that was basically printing $63,000 in cash every year while you held it. Scenario 2, the larger build-out. You develop a ground-up climate-controlled facility in a fast-growing suburb, let's say suburban Atlanta. 60,000 net rentable square feet, 700 units. Total development cost comes in at $7.8 million, including land. You raise $2.5 million in equity from a small group of investors. Borrow $5.3 million at 6.25% on a construction to permanent loan. Lease-up takes 26 months. During that time, you're burning roughly $180,000 in operating losses covered by your equity reserves. Month 27, you hit 88% occupancy. Revenue at $1.20 per square foot on climate-controlled units, 60,000 times $1.20 times $0.88 equals $63.03, 360 per month, or $760,000 annually. Add $50,000 in ancillary revenue. Total gross revenue, $810,000. Operating expenses at 35%, $283,500. Net operating income, $526,500. Debt service on $5.3 million at 6.25% over 25 years. Approximately $394,000 per year. Cash flow $132,500 per year to the equity group. On $2.5 million invested, that's a 5.3% cash-on-cash yield. Modest while you're in stabilization. But if you hold for 5 years and grow NOI to $600,000 through modest rent increases and full occupancy, the sale at a 5.5% cap rate values the facility at $10.9 million. After paying the remaining loan balance of around $4.7 million, the equity investors split roughly $6.2 million on $2.5 million in. That's 2.5 times equity in 5 years, while collecting cash flow the whole time. This is why institutional money never stopped buying storage even when prices got high. The income is stable. Demand doesn't evaporate in recessions. It often increases because job losses force people to downsize and put furniture in storage. The operating costs are low. The tenant base is diverse. Hundreds of people, each paying a small amount, so no single tenant is a make or break risk. And the upside on a well-run facility over a hold period of 5 to 10 years is genuinely substantial. The business in one line: you rent small, cheap-to-build boxes to hundreds of people who never want to deal with their stuff, and the income compounds quietly for years. So, the next time someone tells you self-storage is boring, they're absolutely right. It's boring the way a well-tuned engine is boring. Nothing dramatic happens, it just runs. The operators who win aren't the ones chasing excitement. They're the ones who ran the feasibility study, modeled the lease up, kept the expenses lean, and then did nothing glamorous for the next 7 years. They just collected rent from people who couldn't let go of their old couches. And quietly, one unit at a time, they got rich.